Hello and a warm welcome to this week's edition of Econoday Unplugged. It's Wednesday, the 2nd December 2020. Mark Penders, stateside, Brian Jackson's in Sydney, and I'm Jeremy Hawkins here in London. And some positive news to begin. We heard yesterday that the UK became the first country to approve a Covid-19 vaccine following the completion of large-scale clinical trials, in this case, the Pfizer-BioNTech version. Delivery is expected next week, and hopefully the rest of the world will not be too far behind. So, having begun the podcast on an unusually optimistic note, let's see if Mark can keep it going in his part of the world. So, Mr. Pender, what's happening your side?
Well, I would like to be optimistic, but the Federal Reserve's Beige Book has just come out, and readers of this know that the last thing this report is optimistic at all. It's always very, very subdued. It's just come out. It's 2 o'clock Eastern time, and on Wednesday. And what can we say? Their general headline description is activity is rising at a modest to moderate pace. That would actually be an upgrade from slight to modest in their last report in late October. Yet, of the 12 districts, 5 are reporting conditions below pre-pandemic levels. So that's a negative. This is it's always, they always try to get it mixed, but I can tell you from the headline that it's going to have a little tilt to the positive. And they talk about higher than expected or higher than average growth for manufacturing, distribution and logistics, home building, and existing home sales. Now, that is a downplaying existing home sales. They're very, very strong. And although not without disruptions. And that's, I think, the key. They're going to be pointing to COVID-related disruptions into economic activity. They once again are citing, and this is assembled through their contacts throughout the country, the 12 different banks and their business contacts. They have board members, separate boards that are important industries represented in the different places. So they have immediate contact with actual business. Now, this is anecdotal. There's no numbers. This is just descriptions. And so from their banking contacts, they continue to describe trouble for commercial lending. And where it's going to be in retail and leisure and hospitality. That's where a lot of this trouble, of course, COVID related, is hitting. And now we have a little bit of a line. Increase in delinquencies in 2021 is more widely anticipated. So that's going to be a little bit of a negative there. So they're talking about the risk of foreclosures, and this is something very important that Jerome Powell has been talking about this week, and the need to keep emergency loan programs open that the Trump administration has scheduled to close down. Let's see, but now let's get to the employment. Now, Friday's employment report, what to expect for that. Let me just tell you what our forecasters on the Econoday panel are looking for: 500,000 increase in non-farm payroll. That's really the central number to watch, and that would be significant slowing or tangible slowing from prior months, and including 638 in October. So, but this description would be, I guess, on the downside. Our consensus range is 200,000 to 610,000 rise for non-farm payrolls, and the Beige Book is describing employment as having rose since late October, but the pace was slow at best. So that doesn't look very good. And slow in normal times would be a 50,000 gain, for instance. But it says the employment recovery remains incomplete. So that's going to be a headline when you read your Econoday text. Firms are continuing to report the difficulties in attracting and retaining workers. That's a bit of a mystery, given that the unemployment rate is near 7%. But they're not giving me too much explanation on that. They're talking about COVID cases hurting schools, plant closings, and fears of infections. They've cited that before, that the labor market is being constrained. people looking for work are being constrained by concerns over COVID. And so there, and it includes absenteeism and attrition. So there we go. That's our explanation is COVID. Child care is once again cited as an issue for people not going into the labor market. Again, a COVID related. And prices. So now inflation is really going to be the big thing to look for in a Federal Reserve statements now, because the disconnect between the unemployment rate and interest rates or monetary policy through the last cycle that we talked about so much, that the natural rate of unemployment may be very, very low. So really, we're looking for inflation indications. And here, the prices in most districts are modest to moderate. Now, let's look at the last report. And their description was more on the modest side. So there is a little bit of an uptick in inflation, I guess. Boy, that's real slight. That's what I'm talking about. That's really kind of these nuances and splitting hairs. But they do say that selling prices of final goods rose at a slight to modest pace. And so that's kind of a less downbeat vision on prices. This is done 2 weeks before your Beige Book is released on the Wednesday, 2 weeks before the next FOMC announcement. And that will be coming up in 2 weeks. And this isn't going to change any expectations for that. That's going to be a non-action FOMC. The Federal Reserve, I have to run and report this. I'm going to miss your description of what the Bank of England might do with Jeremy, with the negative rates, but the Fed is definitely not going to go there. And
can I ask you one very quick on? Say,
yes.
I know you got one very quick one on the FOMC. There's a lot of talk last week, following on from what you're talking about, the Treasury pulling the funding for some of the Fed's emergency lending programs.
Yes.
Will that have any implications for what the Fed might do? Perhaps not in December, but perhaps early next year.
I think there's this in between period when Janet Yellen will take the helm of the Treasury and then return the support for these programs, and so you're getting these kind of vague gray areas, which is very hard for us to describe in our content, by the way. But I think that's what's going on, and when the dust clears and the new administration is put in, I think you will see a return to emphasizing that. Yet, demand for these actual loans, the companies that have actually taken them, is very small. But the Fed argues that, well, just their mere existence, helps stabilize the market, helps give confidence, and supports, credit flows to businesses and households. So, but that is, I think a marginal third area of policy. I think what really is going to go on next year is going to be QE and what they do with that, and how, if these vaccines go through. Then we will begin talking about withdrawing stimulus, and then we would be talking about raising the federal funds target, which is sitting just about at zero right now. So I think that's probably where the bias will probably be.
Okay, excellent. Thank you very much.
Okay,
I shall let you get on with your scribbling.
Okay, have fun, guys. Talk to you later.
Okay, cheers, Mark.
All right.
Cheers.
Okay, Mr. Jackson, then. Well, perhaps if you could first, for listeners, give us a quick update of what's happening on the COVID side down under, and then, if possible, I'd like to have a chat with you about perhaps what's going on between Australia and China.
Sure. Well, things are moving in the right direction in Australia in terms of COVID. As people know, the area where the biggest problem has been down in Melbourne and in Victoria over the last few months, but that's improved quite significantly in recent weeks. Cases have been at zero for a good period of time now, and right across the country now, it's definitely tracking in the right direction. So public health restrictions are being eased, borders are reopening across the country. And hopefully that will be translated into improved conditions for households and businesses right across the country. So things are moving in the right direction, and obviously with hopes of a vaccine coming in the new year. That's looking good. Elsewhere in the Asia Pacific region, there are still a few concerns. In Japan, still a few cases in Tokyo in particular. When we're talking about Hong Kong and Singapore, they've been negotiating a travel bubble to start as soon as possible, but that's been delayed a little bit. Probably won't happen now until the new year. So in general, things are definitely a lot better in the Asia Pacific area.
Actually, let's catch up before we just get on to the Australia. On Japan, it seems from what I noticed some of the figures, we had 5 consecutive gains in industrial production now as of October. The first gain in was it retail sales in 8-9 months, whatever it was. So it looks as if, despite perhaps some COVID issues, the Japanese economy is starting to improve a bit now. Yeah,
I mean, the retail sales number is there's a bit of caution there. It was basically a year-on-year change. And the base effect was impacted by a consumption tax 12 months ago. So
of course,
that was a bit of a spike caused by that. But you are right. In general, things are improving even in Japan. I mean, bear in mind the Japanese manufacturing sector was already in pretty weak position going into the pandemic. So they've sort of clawing their way back from an already weak starting spot. But I think right across the region, but also in Japan. We're seeing significant recovery over the last few months. That said, external demand has sort of been weighing a little bit on that, given the renewed lockdowns that we saw in Europe over the last few months.
Okay, fair enough. Thanks for that. All righty then. Seems to be increasing media coverage of what looks to be sort of growing political tensions between Australia and China. Obviously, it's been around for some while now, but it does seem to become a little bit more heated. Well, A, what's going on? And B, I suppose, given the importance of China as an export market to Australia, how important is it to the Australian economy? And indeed, for that matter, have financial markets actually started to take any notice of it yet?
Yeah, I mean, this has been simmering for a while. If you go back to 2018, the Australian government banned Huawei from participating in the 5G network. That was not well received. The Australian government has also been making comments about Hong Kong situation, and then earlier in this year about the need for an inquiry into what happened with COVID-19. So all these sort of issues have been bubbling along for a while now, but it does seem to have escalated in the last few months. We've had Chinese authorities put on various trade restrictions on Australian exports. So far, nothing too big, but just enough to send a pretty clear message that they're not happy. And it's definitely a concern for Australian officials. And then just in the last couple of weeks, it's sort of taken even a more serious turn, I guess. Here in Australia, we have some soldiers that have been accused of war crimes in Afghanistan over the last 10, 15, 20 years. Investigations are proceeding into that, but the Chinese Foreign Ministry has commented on that in a rather provocative way, and that has not been well received by the Australian government as they try and investigate these accusations. So there's a real sort of cooling of relations between the two governments. So far, hasn't really had a big impact on the trade between the two countries, but it will be interesting to see how that goes. As you said, Australia is China is Australia's biggest export market by far, and we are Australia is a very important supplier for particularly iron ore, but other important minerals and commodities for China. Going forward, I think that there will be I'm confident cooler heads will prevail, and won't see a really serious escalation of these tensions, but it's just I think an inevitable tension that there is in the Australia-China relationship. Obviously, Australia has very strong political and military ties with the United States, but very strong commercial ties with China, and negotiating that balance has always been a challenge for Australia.
Okay, fair enough. Partly sticking with Aussie, but more generally, I mean, we're in a sort of a period of, I guess, relative dollar weakness at the moment. So counterpart to which is obviously currency appreciation elsewhere. Now, certainly, I think you've mentioned on a podcast before that Aussie strength hasn't necessarily gone down too well with the RBA. And I guess it won't be too happy with current levels. But today, there's also been some talk of the Reserve Bank of India intervening to slow rupee appreciation. So I wonder if from your sort of where you sit, if you think we're getting to the stage now whereby sort of a combination of risk on trades in general and US dollar weakness are starting or could cause local central banks some real policy headaches, or are we not at that point yet?
I think there's still a little bit of way to go before it would have a direct impact on policy across the region. But yeah, it's definitely a factor that not only Australia and India, but also Japan, or obviously also is very mindful of the exchange rate situation. So yeah, it's and as I said earlier, the fact that renewed lockdown in Europe and to a certain extent in the US has weighed on the external demand for much of Asia Pacific region. That's another factor that's going to cause them to be concerned about currency strength. But this is something that Asia Pacific policymakers are used to dealing with and sort of factoring into their decisions. And what has actually been pleasing, I think, over the last few months is even though external demand has been a little bit soft, you are seeing sort of some domestic demand picking up the slack, and so that hopefully takes a little bit of the pressure off as well.
All right, it's good to hear. Okay, anything else from your side?
No, I mean, just we're in the middle of the monthly sort of PMI cycle at the start of the month, so we're getting a few more today and later on in the week, and it's just encouraging that it's generally showing this continued recovery in activity. So very strong pattern of extreme weakness in June, in the June quarter, strong rebound in the September quarter, but now we're seeing, as we move into the December quarter numbers, that seems to be consolidating. So, if we do have, a real global pickup in economic conditions next year with this vaccine, then it's looking reasonably optimistic for 2021 for the Asia Pacific area.
Excellent. Let us hope so. Okay, thanks for that. Well, I guess sort of compare and contrast really when it comes to my side of the world. The COVID numbers out of Europe, I guess it looks now as if at least they peaked, and they are starting to decline in most countries, but nonetheless they're coming from very high levels. So we're still talking about lockdowns in a number of the big countries. France has started to lift its lockdown as of last weekend, and it's hoping to complete the process by the middle of December, but already it's indicated that some hospitality areas will be closed over Christmas. Italy still has very strong restrictions, and in Germany, although it's only a soft lockdown over there at the moment, last week they announced that would be extended until at least December the 19th, with the possibility of it running all the way through to January of next year. So it's still the case that the economic data, from what we've seen, which as Bram was talking about PMIs, well, in terms of Europe, it's really the only sort of indications we got, particularly of November at the moment. But PMIs out of Europe were disappointing, really suggesting that we're going to see certainly a contraction anyway in service sector activity. Manufacturing's holding up rather better, as it did during the first wave of lockdowns, but it wouldn't surprise me at all if we saw a fairly negative GDP reading as far as the month of November is concerned, and the possibility of not much better when we see December as well. So fourth quarter Eurozone GDP is going to be weak. It's just a question of how weak it's going to be. And against that kind of background, of course, it's just fueled a fire of speculation that the ECB will be coming out and cutting, or at least I should say, easing policy next week. Talk more about that next podcast next week, but suffice it to say, as things currently stand, if we don't see a significant new package of measures coming out of the ECB on next Thursday, then investors are going to be extremely disappointed. Prospects of easing really continue to be buoyed as well by this lack of any progress on trying to sort out the European Union budget. At the moment, as we speak, Hungary and Poland are still refusing to sign off on it. Of course, given how EU politics works, until all the various EU members have agreed to the programme, then it's not going to come to fruition. So at the moment, the EU is facing, starting 2021, without a proper budget, which can have major implications for spending and hence, for the way the economy is going to fare as well. So it's not looking too good there at the moment. They're still hoping that this impasse can be resolved ahead of the EU leaders meeting. It'll be the last summit before the end of the year. That's due on December the 10th and the 11th. But if nothing comes out of that, then really is it shaping up to be a royal mess as far as Europe's concerned.
Well, just with this impasse at the EU level, though, is there scope for particular countries to do more on fiscal policy outside of that process?
I think there is. And I mean, to be honest, that's a very good point, because what we've seen so far, although I guess at the moment, all the talk is about this fiscal rescue program, the 750 billion euro program the EU Commission is trying to put through, and that's tied to the overall EU budget itself. Most of the fiscal stimulus we've had coming out of Europe so far has been very much driven by national governments. They were allowed to increase their public sector deficit to GDP ratios above the 3% limit, which has been part of the so-called Growth and Stability Pact, which puts the fiscal conditions or rules across the European Union as a whole. That's been wavered really since COVID, and governments have taken the opportunity to come out and spend a lot, reduce taxes as well. So countries like, Spain, Germany in particular, and France are going to see their budget deficits really go through the roof as far as this year is concerned. So I mean, the answer to that is yes, in terms of there is certainly, I think, still scope for individual national governments to do their own thing. But just in terms of having a budget for the European Union to try and keep that side of it working, it's really looking pretty messy at the moment. What else can we say? I suppose that next week, with this EU leaders meeting, the other focal point there is going to be, surprise, surprise, the dreaded word Brexit. As we record this podcast, despite having talked about this thing over so many previous weeks, there's still no agreement between the UK and the European Union as to what any trade relationship is going to look like once we get beyond the current post-Brexit transition period, which ends at the end of this month. Now, from what appears to be coming out through various media leaks and so on, it still seems that there's a reasonable degree of optimism that something will be emerging over the course of the next week, or possibly even the next few days. But as we said before, don't hold your breath on it, because we've been so close and it's fallen apart in the past that it could happen again. So anyway, that is very much still in the offing at the moment. So we've got Brexit uncertainty, we got the issues surrounding the EU budget, all of which really does leave the ball in the poor old ECB's court in terms of who's going to try and get the Eurozone economy going again. Because I mentioned the fourth quarter numbers are going to look bad. The first quarter may look a little bit better, but on the whole, it does look as if the Eurozone economy really needs all the help it can get at the moment. And I guess one other thing I should mentioned when we chatting to Brian about the strengths of some of the regional currencies now versus the dollar, because the dollar is so weak. Well, the euro is also having a very good run against the US currency as well. It broke above 120 on the dollar for the first time since 2018 earlier this week. And people may remember that we're back in September times, not before that. We had the ECB making noise to the fact that they weren't really too happy about the level of the euro at that time. And that was below where we are now. So wouldn't it be at all surprised to see some comments coming out of the ECB next week to the effect that, the exchange rate, although they don't have a target for it, it is very much, part and parcel of what goes into their monetary policy decisions. So expect them, if anything, to probably come out and try to talk down the level of a euro, because they're not happy about current levels, particularly given the weakness we have, of course, of inflation right across the Eurozone at the moment. The updated figures from this week for the flash figures for November showed core inflation, which is the main measure, running at just 0.2%. And so that's still down at a record equaling low. What else shall I mention from my side? From the UK, the Chancellor over here announced a new stimulus package, his latest spending review last week. Really, I suppose some most interesting figures coming out of this are the downgrades of some of the economic expectations due to the second lockdown. So the economy is expected to shrink by some 11.5% this year now. Now, okay, they're forecasting a 5.5% recovery next year and up 6.5% in 2022, but it means that GDP in the UK is not expected to return to its pre-crisis level until we get to the end of 2022. So, the outlook really for UK growth, unemployment, and everything else at the moment is looking not too good at all. Also, I should mention, part and parcel of the spending review, we get some new forecasts coming out to the Office for Budget and Responsibility. They're responsible for putting forward the GDP growth numbers, the inflation forecast around which the budget will be built. But rather than spending too much with that, one of the most interesting aspects of this was that they came out with their assumptions or projections, if you like, or for what a no-deal Brexit would mean. And they're effectively taking the view that if we can't get some kind of trade deal agreed, then we're going to see a spike in inflation, as we'll see tariffs being introduced on goods coming into the UK, coming into the UK out of the EU, in the same way as the UK will be sticking tariffs on goods going into the European Union as well. And they think, that consumer price inflation will be at least 1.5 percentage points higher than it would have been had they had a deal. And GDP growth in 2021, they think will be cut by some 2 percentage points, with a long run view of 1.5 percentage points smaller UK economy than would have been the case with a deal. So really, I guess if you want to be sterling bearish, there are a lot of numbers doing the rounds at the moment which really don't look too clever unless these politicians can get their act together and really come out with some kind of a deal.
Has there been much evidence, though, of UK trade flows shifting, away from the EU, towards other parts of the global economy?
I've got to be honest and say, not really. It's one of these issues because, by far and away, our largest trading partner is, surprise, surprise, the European Union. It's only 20 miles across the English Channel. So, even more than perhaps for a lot of other countries, it's just the logical place to do business. Now, the UK government is busy touting, it's looking around for these trade deals. We'll have to see what Joe Biden says, but they're trying to get one through of the States. They actually signed off on one with Japan, week ago, or a couple of weeks or so ago. But the Japanese share of UK exports is tiny, and we're talking a couple of percentage points or so. So that's not going to make a great deal of difference. But what we are seeing is that there's something of a minor panic starting to take place now on both sides of the English Channel regarding what might happen. A, certainly if there's no deal on the Brexit, and B, even if there is a deal, companies, businesses have been so uncertain for so long that they're simply not prepared for what's going to happen next year. And that's been reflected in the likes of the UK PMIs through a big increase in input buying. Stock numbers are going through the roof, and that's certainly helping to support the UK PMI headline numbers at the moment. Now, we're probably going to see some kind of unwinding of that coming into the first quarter of next year. So although, the Bank of England is still looking for a contraction in UK GDP in the current quarter due to the COVID effects, and then hopefully some kind of rebound in the first quarter, where it may be that, due to this, the Brexit distortions, that the first quarter doesn't look very good either. So it's Brexit and everything else is making a right mess at the moment of trade flows for the UK and indeed the European Union. And whatever happens in terms of this trade deal is going to be very messy, I should think, for most of next year. Okay, well, I guess that's probably my lot finished. So if you're done for the day.
Well, with Mark having left early, I guess we could have a long discussion about cricket, but
well, of course, it is mentioning now that with England having thrashed South Africans, they are now top of the T20 league. Looking ahead, of course, to the World T20 finals next year, that can only be good news.
And meanwhile, Australia has just beaten India in a cricket series as well. So
I did notice Mr. Smith is suddenly Mr. Smith's doing very well again, which is very bad news if you're English.
That's right, but very unintelligible if you're American, probably. So we won't go too far.
We would hope so, indeed. Okay, thanks, Brian. Right, well, let's wrap it up there then for today. But we'll be back again next week. And in the interim, you can always keep up to date with the key market moving data and events in Econoday's global economic calendar. Thanks very much for listening. Stay safe, and we'll see you next time. Bye for now.